Hey folks, welcome to a product review at Finominal. Today we're going to look at senior loan ETFs trading in the US stock market. Now, what's a senior loan ETF? It's simply a ETF that provides exposure to a diversified portfolio of senior loans, which are also known as leveraged loans or bank loans. The typical borrower is a private equity company that uses these loans to buy companies. The average maturity is between 3 and 7 years. And the key difference to kind of the normal bond ETFs you see is that the interest rate is floating. So if interest rates go up, the interest increases and vice versa. Now the three ETFs we selected are products from Invesco, First Trust, and State Street. So let's kick off in terms of a simple portfolio analysis in terms of how diversified those portfolios are. And if we look at the number of underlying loans, we do see that this ranges. So we do have Invesco with only 173 senior loans in the BKLN ETF versus State Street, the Blackstone State Street, Blackstone senior loan ETF, right? SRLN has much more diversified, 621. What's interesting to look at is how correlated these senior loan ETFs are with investment grade bonds and equities. Now over here we see that the correlation to like US investment grade bonds is very low. That's between 0.1 and 0.2 effectively. Having said that, we do see that they are moderate positively correlated with equities, right? Ranging between 0.4 and 0.6. And that's not perhaps intuitive because you think about senior loans, sounds like a fixed income instrument. And I think from a fixed income perspective, investors like it because it's not correlated with the kind of like average investment grade bond in your portfolio. Be aware that you seem to be getting a little bit of equity risk with senior loans. We can also have a look at this from a risk exposure perspective. And if we do risk exposure analysis, we do see that somewhere between 28 to 36% of the risk of the senior loan ETFs simply explained by the S&P 500. Now, majority of the risk is still unexplained, and that's simply interest rate risk, where we do not have a variable for that, so changes in interest rates. Now, that's kind of interesting to think about, right? That there's this equity component, right, or equity driver that impacts risk and returns of these senior loan ETFs. We can also look at them from a performance perspective. And so here we have the track record of these three senior loan ETFs going back to 2013. We do see that the First Trust Senior Loan Fund, FTSL, has outperformed. And it's not only done that on a relative basis, but also on a risk-adjusted basis. So what we can see over here, that from a risk return perspective, the First Trust product has had the lowest volatility and the highest return. So effectively resulting in the highest Sharpe ratio. Now this is a very high level analysis. The one interesting aspect is to ask the question is, why do investors like buying these? So I already mentioned that from a fixed income perspective, they're like uncorrelated, which kind of like makes it interesting from a diversification perspective. The other key aspect is, of course, that these are quite high yielding. So if we look at the dividend yields of these ETFs, these range between 6.5 and 7.6%, right? So that kind of puts them, for somewhere as high yield, right? Or like a very high dividend yield strategy, but it sounds like a fixed income product. So do these instruments create value? Are they interesting? And the kind of like thing we can ask is, we saw that there's some sort of like equity component that is driving the risk return of these ETFs. And so we asked ourselves the question is, can we replicate the performance of senior loan ETFs? And what we've done is created a simple portfolio comprised of simply US Treasuries, T-bills, and S&P 500. And we've given an 80% allocation to T-bills and a 20% allocation to the S&P 500. Now, what we see is that indeed, this very simple portfolio is an almost one-for-one replication of senior loan ETFs. Stated differently, there is not much uniqueness to senior loans, right? They simply represent diluted equity. And that also already kind of concludes our short analysis of senior loan ETFs. So most investors, right, buy them for the high yield. They buy them from a fixed income perspective where they look uncorrelated, but that's of course simply represents diluted equity, as we demonstrated with this very simple T-bill and S&P 500 replication that has a Sharpe that is almost twice as high as these senior loan ETFs. Hope that helps. Have a nice day.